Hey, good morning. Welcome to the room. Hope everyone had a nice holiday weekend. As you know, trading futures does involve risk. It's not suitable for all investors. Information in the presentation is for educational purposes. It's not a trade signal service, not intended to be financial advice. Sorry, it took me a few minutes to get going there. The recording software was doing a little update this morning. All right, I think we're good. All right, opening breath, 2 to 1, and pretty much flat on the AD line. I want to keep my eye on whether or not this 2 to 1, goes closer to 0 or 1 to 1, or if it gets stronger and goes, 2.4, 2.6, 2.9, 3 to 1. So that's where that opening reading is helpful. I turned on the overnight hours just to get an idea of where we traded during the Globex overnight session. Here's our prior day's close, 72.50, so just a tiny gap down. We'll see if that fills or not. If it does, there won't be a 15-minute breakout play. If it doesn't fill, then there will be. For those that are new, the first 15 minutes are a good time to just sit tight and take in some initial observations like the breadth advanced decline line. Look at where are we opening in relation to yesterday's high, low, and close. So currently we're just a tiny gap down, and we're kind of in the bottom of yesterday's range. So we're still within yesterday's high and low, the range from yesterday, but we're pretty close to the bottom. So if we break down below yesterday's low, then I would want to, look at that price level, so 60 and a quarter. If we just tick a couple ticks below it and then trade back in, then that's bullish. Might be a buying opportunity. If we go back and look at, okay, what is our current trend? Well, we're trending down the last couple of days. Yesterday's candle was below the prior day's candle, which was the market holiday. These little two candles up here don't really count that much. So really the last trading day, that Wednesday the 23rd, is back here. I've got a retracement drawn up, which I could extend now to the 24th. Doesn't really change it a whole lot. That's why I had originally just left it where it was. But I'm going to get rid of it for the time being, just to clean up the chart. We do have a pretty solid uptrend line here. Actually, I'll go to my trend line chart. We have a solid uptrend line and the downtrend line. I kind of drew it through the middle of these. And then this downtrend line is connecting some of the highs, all-time highs, and then a couple of these highs on the way down. So we're at a pretty good inflection point here. We've got a Fed meeting on the 15th, I believe, 15-16. Let's check that. 14th. So the Fed meeting announcement should be on the 14th, and as we go, into this last month of the year, last couple of years, the start of December has been kind of bearish, and then that Santa Claus rally has come in, just a week before Christmas, meaning just a lift in the markets. on lower volume. So we'll see if that's the same case this year. Nonetheless, regardless, our volatility has really declined. It's not been talked about a whole lot, but I mean, look at this when we were up in the mid 30s, just I mean the middle of last month, and then just down, 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 all the way to low 20s. So there's still lots of good moves. The 15-minute breakout has really been doing good the last couple of weeks, especially since I've gone to this wider stop. And the lower volatility has not put a damper on that at all. Let's see, it looks like we filled our gap. Yep, so today there will be no opening range breakout play. So mark that down. So no opening range breakout today. Yesterday, look where we came as far as unfilled gaps go. At the close, we came right to that unfilled gap, 39.60 from a week or so ago. So that's why it's important to keep those unfilled gaps on the chart. See, I have them all here, places that we closed and then never traded at since. If you are on toss, you can come down here to drawing sets and just create a new drawing set with whatever name you want. And that way, all of your unfilled gaps can stay on the chart. If you were to, change your drawing set, then, I have one for fibs and one for gaps, and that way you can, mark up the chart and not have to lose your drawings or not have to, I used to have them written down, and it's just a little easier to visually see when they're already on the chart. So having a couple of drawing sets is actually pretty handy. And then throughout the day, you can kind of toggle through and say, okay, we're closest to this 39.60 as far as filling the gap. We came, one tick away yesterday, so I left it. These two unfilled gaps above us aren't going to be super strong. We could even throw in the one from Wednesday, like this. So this little cluster up here, but after that, we'd be making a new high. One thing we did talk about last week is a close above the 61.8. We did get that Wednesday. It was on lower volume, but we did get a close above the 61.8. That's bullish. And the most recent swing low is back. Technically, it's this guy here, this one candle pullback, but I'm just going to use this low because it was a couple of days of a pullback. So down at 39.1375 is the swing low. So if we broke that, then I would look at a retracement short, something like this, where you come down and break below the swing low, and I would look at a 50% short there, even though we've closed above the 61.8. So in order for it to be a nice clean break, and you break above the 61.8, you pull back a little bit, maybe we dip down a little bit more here today, and then round out and move higher. That would be one scenario. If we just roll over from here, you could maybe get a little bit of a bounce and put in a head and shoulders where you have the left shoulder, the head that pokes above, and then the right shoulder that's a little bit lower than the head, and that could take us down. So that's why I say we're at an inflection point. We've got the downtrend line above us right here. We have the uptrend line, and or swing highs and lows I've got marked here. So this is kind of the apex, the point of all those things coming together. So we'll see what retracements we get. Yesterday, typically after a long weekend, I play it pretty slow into the day, meaning I'm just intending to sit on my hands unless a really, really good trade comes up. So all I had yesterday was the 15-minute opening range breakout, which went for 20 points, and that was it. No retracement trades. There were a couple of little things that set up, but we were mostly in the first. Well, we were in like the first 15-minute range for quite a while. This is the 30-minute chart. It's not actually that exciting when you look at the 30-minute. But the 15-minute chart, we kind of stayed within this first 15-minute candle for a while. We dipped below. That triggered the 15-minute breakout short. And then we kind of stayed towards the bottom end of this 15-minute candle, which was the 30-minute low. And then even when we broke below that, we just sort of moved sideways at the underside of the 30-minute low, and that was already the end of the morning session. So the move down that occurred was all in the afternoon, and so that's when the 15-minute breakout got its profit target hit. If you aren't trading the morning, or if you trade the morning and the close, there are some positives or benefits to trading at the close. You have a little bit more information. You certainly have more uh, indication on the trend for the day, and you have more swing highs and swing lows that you can look back on from the day. So this kind of, I would say, so if you take out the last 15-minute candle, because that's the settlement candle, and then I don't like to, have any positions on going into the last 10 minutes or so, just so you don't get stuck in something. And then, so if you go back, let's say 90 minutes before the 4 p.m. close, that's probably your best close window. I'd say 90 minutes prior to close up until, we'll say 15 minutes before. So just basically mirroring the open. Don't trade the first 15 minutes and trade up to 90 minutes after the NYSE open. Then mirror that. You could trade the last 90 minutes and then don't trade the last 15. And I like having that last 15 minutes. I mean, I rarely do I actually day trade in that last 90 minutes, but I know some people, based on time zone or whatnot, they can't trade the open. The open's still going to be your best, by far, bang for the buck. That's where you're going to have your biggest moves occur and the biggest opportunities right at the open. But if you're trading the close for whatever reason, those are, you have some more things that you can reference, and the NYSE ticks. You've got the entire day of high and low ticks. And coming into that last half hour, like 30 minutes before the bell to 15 minutes before the bell, you can get some pretty strong reversals. So there are opportunities to be had. I don't suggest people trade both the open and the close unless you're really seasoned and you have a good mental grasp on your, we'll just say, trading emotions. Because if you trade the open and it doesn't go well, you're going to try to revenge trade the close and try to make it back, as as we like to say. If you have a good morning, you that may influence your decision making, and you could argue that, well, if it's a good trading day, you want to keep trading. But even if you just give a little bit of it back, that kind of sours the mood going into the next day. So for that reason, maybe picking one or the other. And then if you are doing any swing trading, leave that last 15 minutes open to just swing trade and not be dealing with day trades, so you can just focus in on it. I mean, it doesn't take that much focus, but sometimes when I'm putting on a put hedge, you're looking at the trade ladder, you're kind of doing some quick math and looking at the chart. So it does take a little bit of focus. You don't want to make a mistake by clicking on your chart incorrectly. So a whole lot directionally going on this morning so far, anyways. Just within the first 15, this halfway back long, poked through at 61.8 a couple times and never broke the anchor points high. So then we can turn it around and go from that anchor point high down to lows and see if there's any kind of, that again, that's the midpoint. See if there's any kind of reaction there. If we go lower, I'll just extend this anchor point lower. And I need to check our news at the top of the hour. Consumer confidence at the top of the hour. So definitely don't want to be putting on a trade at 7:59 or whatever your time zone is, a minute before the bell, 2 minutes before the bell. If I'm already in a trade, it's nice to have a first target hit already. Let's see. Home price index, which isn't the greatest indicator as far as, it's only taking, I think it has 20 cities, yeah, for the Case-Shiller home price index. That was before the bell. And we're going into the, winter season, so typically there's a slowdown in real estate. So I think the spring will be a better indication of, okay, we've got a little bit of time between, or a little bit more time from when interest rates were 2% to whatever they'll be in the spring, let's say 8 or 9%. If you just came to the housing market in the last year or so, 2% was never really an option for you. So you started running your numbers with these bigger interest rates. And so when you compare, a 7% to a 9% rate, it's not as big of a difference if you're taking out a mortgage than a 2% versus a 7% rate. So I'm interested to see what happens in the spring. And as far as like foreclosures go, that process takes so long that maybe in the spring we'll start to see more coming on. But let's say you stop making payments in August. You got a couple months of buffer, and then a couple months where the banks, kind of trying to work with you, and then you go into foreclosure, and then you got the legal process. So even that takes time. So all these people who are, waiting for those giant foreclosure wave. I mean, there's some deals, but it's not this flood of houses hitting the market. And even if it was, let's say you picked up a house at 50% off. Well, it's not gonna double in price in the next 6 months. So you still have to have the patience to, real estate historically has been a long game. And so the last couple of years with accelerating home prices, I think has kind of muddied the waters for pseudo investors who, are trying to use it to make a quick buck. And if you get a rental property and you get a renter in there, the long game is also your friend, and you can collect your rental income, and the home price doesn't really matter that much. So just like we do here in trading, the tried and true kind of repetitive, you want to create something that's repetitive, that you can do consistently, so that you have variables that you can control and replicate, so that you can build this set of observations that then becomes ingrained in your subconscious and is, your intuition is based off of thousands and thousands of occurrences. If you just throw a trade out there and it works, you probably don't have an idea of how to repeat that unless you had a list of, criteria of, this is why I'm placing my trade. And even so, if I said, wait for a swing low to break, wait for the 61.8 to break, and then buy or sell at the 50% retracement, there's still the context around that setup, which also adds another layer of complexity. So the simpler you can make your trading, and I would say your investing overall, the better. And that goes for real estate as well. If you are not um, a handyman or woman, or if you are, not buying property where you live, which I would, in most cases, suggest not doing, there's a lot more factors and risk that you're taking on. Even just the understanding of how, I know this is a trading room, but I know a lot of folks are also have their hands in the real estate or rental market, but even just having the understanding of how some of the construction and remodel ins and outs work, and the different contractors and the way certain prices and things come together, you can easily, I could see, get taken, or go for a ride if you don't have a good understanding. So the same thing goes for trading. If you're just, oh well, I've got $500,000 to play with, it doesn't mean that you should jump in and trade 10 mini contracts. You really want a solid understanding and have some practice. I would still suggest starting on a paper account and then move to the micros and move to the minis, just like we talk about the progression. Otherwise, you're just throwing money away, or just hoping to get lucky, and that's not really a strategy. Pretty slow here. You can see the 512 tick charts. This is one of the things that's great about using the 512 tick. Seeing how slow these candles form really tells you a lot about the volume and how much trading is going on, and it's pretty slow. We're down at the bottom of yesterday's range, so we have the potential to break yesterday's low and maybe accelerate. But for the time being, I'm going to leave this full halfway back up. We've got about 8 minutes before the what did I say? Consumer confidence number. So more than likely won't get any setups before that. NYSE ticks are also pretty tight range. We have interesting enough, a stronger breath than we did at the open, which is pretty bullish because we are lower than where we opened. So that's bullish. The advanced decline line, meaning there's more volume going into up stocks now than there was when we first opened. And there's more stocks, the AD line, more stocks are actually trading up than they were at the open, even though the S&P is down. Then the NYSE here, a very tight range with these extremes of the high and low ticks, just means that there's not really a lot of stocks swinging up or down all at once, which is reflected in this choppy sideways movement here on the 512. So you start to kind of paint this picture with just a handful of little they're indicators, not indicators in the same sense of like a MACD, but more so real-time indicators, if you will. Yeah, sorry, Stan, the audio at the start, that my screen capture recording was doing an update, and then it kind of froze on me, and so I use this Snagit, which is a TechSmith, Camtasia software, and it's good in most cases, but sometimes it'll drop the audio mid-recording, or for whatever reason, the start of the audio with GoToMeeting. The new GoToMeeting platform is a lot more takes a lot more resources also than the old platform, so it's clunkier and blockier and more, I call it bubbly, like like if you look at an iPhone, like the texts are kind of big and bubbly, and that's how GoToMeeting's been the last year, and it's takes up a lot more resources, which is kind of annoying when you got Thinkorswim takes up a lot of resources too, even though I only have Toss, my Excel, and GoToMeeting and Snagit up. That's even with 16 gigs. It does take up a lot. Fun fact: if you are on Toss, if you go to the Help tab, you can click this Collect Garbage. And especially if you have your Toss open, I would recommend closing it every night and opening up new. It's also an easier way to reset your NICE tick chart instead of having to go in, change the day, and then change it back. But that will help speed up the platform a little bit too. But I digress. I like to use the full halfway back as my first kind of big support or resistance level, outside of breaking the prior day's high or low. That's kind of like the first intraday support or resistance level, because if you don't even make it to the halfway back of the day, we're either selling off in a kind of strong fashion where we're not making any retracements, in which case the 15-minute breakout would likely pick that up and you would get short on the momentum play to the downside. And it also just forces you to be patient. Sometimes, like the first half hour here could be slow, and then you get this consumer confidence number, and all of a sudden, pow, you get some movement, and then that shakes out some stops, and all of a sudden we're trading up at highs for the day, and then we break above the top of the 30-minute range, set up in the long, and we're off to the races. So if you come into the trading day guns blazing and blow through all your bullets, then you're kind of left with no ammo for later in the day, and if you missed your target, then you're kind of stuck. Let's see here. Yesterday, yeah, we did have a crossover yesterday. Let's see here. Oh, it's 28th, 29th. Why is it? Oh, that's right. So yesterday, I think, Mateo, we're talking about this one here. And again, for those that are on Toss, see how like my charts are both linked because I've got that drawing set the same. If I were to flip it to a different drawing set and make a drawing, it would not show up on the 512 tick chart. So, and people are using things besides Toss, but that's a handy little trick there. Now this, let's see, there's that. I think that's the one you're talking about here. The first halfway back long for the day. Drawing from the first 5-minute bar low to the second 5-minute bar's high. When we broke that 61.8 here, this swing high was only one candle. And so let's see, an 825 is what you're referencing. Yeah, it would be like that. I didn't draw this up as a crossover trade. This swing high was, I felt like a little bit far away from the 50%. More so, the reason I didn't take that yesterday was just because it was the first day after a long weekend. And so, the 50 lines up, the 50 short lines up nice with the 50 long, which is a plus. And so it's not a bad setup, just in part because this swing high technically was the most recent swing high, but it was only one candle. And so even if you drew it that way, that would have kept you in the trade still. But no matter which one you took, you got a first target and that was it. So just kind of going into the day a little more conservatively, I guess, is why I didn't take that one. Here's our top of the hour, a little bit of a run up, but no major rip. If we were to make a new low, I would definitely have moved my anchor point down. So at this point, the anchor point that I'm attached to is the low for the day. But let's say it was, back here. So long as the 50% does not trade, then I'll keep moving the anchor point down until it does. So this is a perfect example where, okay, if I had just put a limit order at the 50%, the halfway back of the day, well, it just ripped right through. There was no pause there. So I want to use that larger halfway back short as my sort of hypothesis. Hey, there could be resistance there, and if there is a pause, then I will draw up a retracement short on the 512 tick chart and take it here. That lowers my risk, shrinks the size of the drawing. I can still use the negative 23% target of the 15-minute or the 5-minute chart. I can still kind of shoot for that, but I'm going to enter on the 512 tick chart. And so now technically we have a 50% long that broke, even though, see how the two anchor points are attached to the same candle? That means it's a pretty small drawing as it is. So I'll draw up this next 50% long. Again, not with a limit order there, but just with a, let's see what happens. Crossover wise, this would be the crossover, so it's giant. There's no swing low on the way up other than the low. So that is not in play here. We'll mark the high and low of the first 30-minute range. Remember, our breadth and advanced decline line are stronger than where we were at the open, so those are telling us bullish here. And at this point, we're trading within the first 30-minute range. At the bottom of yesterday's range, we're pretty much flat on the day. We already filled our gap, so more than likely, I never want to say never, but more than likely, trade opportunity wise, it's going to be the bottom of the 30-minute range or the top of the 30-minute range. Now that could be a long or a short. If we were to come down and make a double bottom, or even break below lows on the day just by 2 or 3 ticks, and then and get a low tick on the NYSE, and then trade back in to the 30-minute range, that could set up a little long. The opposite would be true at highs. If we come up to the top of the 30-minute range, just meaning the 30-minute high for the day, the first 30 minutes, then and we break highs by a couple of ticks and then fall back down, then drawing up a little retracement short, especially if we get a high tick. If we break down, we move lower and we drop like 1.5, 2 points right away, and we don't have a low tick that lines up with that low price, then drawing up a retracement short that's just underneath the 30-minute low, because you have now resistance there. You got the 61, plus you have the low of yesterday. That's 2 resistance points if we were to break lows. So going into the day, I'm looking at pretty much the same areas. The crossover trade that Matteo mentioned, the halfway back for the day, which would occur before a potential cross, top and bottom of the 30-minute range, the prior day's high and low. Those are all retracements separate from the 15-minute breakout. So, that kind of repetition kind of builds you a framework or almost like a lens to look through, like binoculars to look through, and you can be more focused. If you're looking, through binoculars and, you're looking out across the ravine at a bear or a moose or something, and you're not seeing everything else around you, but you're really focused in and you can see it a lot clearer. If you take the binoculars off, yeah, you can see more, but it's going to be not as clear. You might, see the eagle and the bear and the moose across the way, but when you really get your binoculars on and focus in, it becomes a lot easier to make sense of what's going on. See how jumpy it is up and down here when you're in the middle of the range. Going back to that crossover that Mateo brought up, after the first like main halfway back of the day, I don't keep trying to take crossover trades. The crossover just means I draw up a big halfway back of the day, in this case short. The short fails its 61.8, and let's say there was a little swing low here. I could draw up a long that crossed over or went through that larger halfway back of the day. So its anchor points were just outside the 50 and the 61.8. After the first one, I don't want to be taking more crossover. So that's why like this one as a short would not be valid because we already had our first large halfway back of the day from highs to lows in this case fail. So I don't need to keep taking it. Just like if we had a high ticket highs and then we made a new high in price and then we had another high nicey ticket highs and then we had a new high price. I don't want to try to short those high ticks after the first one, the first main high tick, because a trending day is going to have high ticket high, new high price. High ticket high, it might only be 10, 20 seconds, and then new high price. But it's going to continue to get those high ticket highs. And the chart, the nicey tick chart, is more than likely on a up day, those high ticks will be high, but then the low ticks on the day will be closer to the zero line. They won't be super negative. Whereas on a range bound day, see how up until the last couple of minutes here, most of the nicey tick spread of data here is pretty much symmetrical to this white. That's the zero line. We got a move down to like minus 300 and plus 300, and that was our range. So now that we're getting a little bit of lift here, we're starting to see some more high ticks come in, and sort of the low ticks are kind of lifting. Just like you'd have higher lows put in, you can look at the same swing highs and swing lows as they relate to the nicey tick. Yeah, I do have a video. I think it's actually called The Crossover Trade Explained on YouTube. I don't have my browser open here because it kind of slows things down a little bit. But if you just search crossover trade E-mini mind on YouTube, it should come right up. Yeah, there you go. Thanks. Yeah, so Mongoose put the video and link in the chat there. Here, I'll put it in the send it there. So our breadth is now 4-1. We opened closer to 2-1. So definitely more bullish than bearish. Like even though we're basically the same spot where we opened from an under the hood perspective, there's more bullish momentum here than bearish. I know we broke the 61.8 decisively. I would not adjust my anchor point in that case like this. I mean, these two highs are pretty close. I left this here just as a reference, because if I start turning around and drawing a short and then I zoom in really far here, you could easily lose sight. That's why it's nice to have the side-by-side charts with the bigger time frame on the left. Because if I start drawing, okay, here's a short, and then you come in and start going from the higher low up to a high, you really don't you're not seeing the big picture, and you can end up, that short would have stopped you out, this long would likely stop you out. So it's just not. You're going to be better served to pull back a little bit, just like we were talking about with real estate, having a little bit of patience, zooming out a little bit, not getting sucked into, the quick movements and whatnot. Understand that, okay, that it's an inside day with a inside the 30-minute range scenario. You don't need to force anything. If there's no good deals out there on a house, then you just sit tight. You never need to buy a house, whether it's an investment or, let's say you get kicked out of your house. Actually, I was in a situation similar to that. We had a condo years ago, and um, they kind of arbitrarily changed the dog policy and said, well, you can't have your dog anymore. So we're like, well, all right, we had it all fixed up and ready to sell anyways. And we said, well, okay, well, we'll move then. But even so, there are options, and if you train your brain to think in a this or, what about this or this option or this option versus a this or that. Like if you just limit yourself to, well, we either um, buy this house or we live on the street. If we don't, there's one house available, and if we don't put an offer in, we're going to be homeless. Try to think, okay, that's one option, likely not a likely scenario, but okay, we could buy this house, or we could go rent an apartment, or we could widen our search and look for houses in another neighborhood, or we could this or this or this or this, and it's just a good way to help train your brain so that when you're looking at trades, it's like, okay, well, I could take, instead of thinking, oh, I have to take this, I have to get in a trade right here. It's like, or I could sit on my hands today and not take a trade and maybe take a trade later in the day or the next day. Or I could sit on my hands for 2 days and have one good trade on Thursday and, end the week up 15 points. Or, you know, it's just a good mental, I guess, mindset way to feel like you have a little bit more, feel like you have more options, which in some ways gives you a feeling of control. I tend to be, I like control, which is why I like to trade and kind of manage my own financial situation versus just being hands off and giving it to a financial advisor. I'm sure most of you are in a somewhat similar boat as far as managing your finances. You want to take control versus just sit back and collect a 9 to 5 paycheck and kind of mindlessly check out. But yeah, in these situations where we're still inside yesterday's range, we're inside the 30-minute high and low for the day, and we're coming off the holiday weekend. It's just, you can't force it. Much, much better to sit on your hands until you get some sort of break outside of the 30-minute range than try to make something happen within it. Yeah, as you can probably tell, I'm not a huge fan of the doomsdayers. Oh, the stock market's gonna go to zero and we're all gonna die and uh, everyone will be homeless. And it's like, well, if the stock market goes to zero, there's a lot more problems than everyone's 401ks. And historically, going back to the start of the stock market, anyone can look at the chart and say, okay, well, what was the trend since for the last 100 and whatever years? Well, we're higher now than we were in the Great Depression. So if you shorted and stayed short, you would have lost all your money. But if you're just trading, or if you're trading in addition to a longer term investments that you have, we can do a lot of things like buy puts, short, go long or short in small waves and catch these shorter moves where, yeah, you do have periods of sell off and rallies that you can jump in and accelerate, make more money on the move up, not just from, your retirement accounts or whatnot. Yeah, I don't really see any retracements in here. We're within the 30-minute range, and so I mean, like the retracement that I have drawn up, 39.66. Really, that's a 5-minute drawing, even though you're looking at it on the right chart, which is the 512 tick. Um, and so I'm not going to take any trades until we either double top or double bottom, meaning come up to the high or low of the day. Then I can assess, okay, what are the nicey ticks doing? At this point, the breadth and advanced decline line are indicating there's a little bit more bullishness than bearishness. So if we can get a little bit of lift and get up above the 30, we'll call it 39.75, there may be an opportunity for long, but we're creeping up on the hour mark already. And if I don't have a trade in the first hour, that really diminishes my chances of having a trade in those last 30 minutes. So never say never, but certainly diminishes the chances. Take a look at the 1-minute chart. I don't like to necessarily drill down super small on a 1-minute chart when we're within the 30-minute range still, but just looking for hammers or inverted hammers at highs and lows of the day. Well, we haven't really traded at the high. This is the high, no hammer there. This is the low, or no inverted hammer, no hammer at the low of the day. Really not much in here either. Something like this. It's not. I wouldn't really call it a hammer. It's got a long tail. That corresponded close to a low tick. 11 was the low tick. So even that's not that great of a setup. Yeah, when things are slow on the larger time frame, the last thing you want to do is go to a smaller time frame and try to pick your way through it. I mean, if the range is huge, that's one thing, but it's probably not going to be a slow day with a giant range. Like, what are we, 39.61 up to a 75. So, inside of 15 points, that's not a huge range considering, the 15-minute breakout is getting 20-point moves after, 10 or 15 point first 15-minute candle. So right there, you're at 35, sometimes 40 points. Just, I mean, you go to an average true range or something and get a more exact number, but creeping up towards highs though, so I do have my eye up here. Technically not a true double top yet. Came one tick away from highs. I'm going to get rid of this retracement now, just since I'm really only focusing in on the high and low of the day here. Next Monday, a week from today, will be the master class. I know a good handful of folks in the room here have been through it before, so you can go through it as a refresher if you want, or let someone else know about it. But this time of year is a nice time of year to really reflect on your trading and get your ducks in a row for the upcoming year. If you wait till right at the end of the year, sometimes you end up losing time just with the holidays and gatherings and stuff. So trying to get organized and plan ahead is beneficial. I would consider a double top or a double bottom, like taking it even if it wasn't the exact same price. But one of the troubles with here, let's say we come down and break the swing low right here. Well, the full halfway back of the day won't be too far below that. So if we come down and break this swing low, and then we stop at like 39.88, well, I wouldn't want to take that as a short because we're basically stopping at a potential long. So I wouldn't want to take a short like that. If we came down and broke that 61.8 and we got this 50% to line up with this cluster of lows back here, well, now we're getting close. It's almost like we're down in the middle of the range, and then that has a weaker chance of getting follow through. So really, I want the market to break above the 30-minute high just briefly, become rejected, then have the 50% line up somewhere near the top of the 30-minute range. Or break out of highs and then set up in a long where the 50% lines up with the top of the 30-minute range. Which is probably the more likely scenario today. Even though it's been slow, if we break out, we could get some movement, which we're kind of doing. So here's that, a couple ticks and then immediately rejected. Let's see if it's going to go up. It's going to have to happen right now. You can't, come down and then fall back into the middle of the range like, in the next 30 seconds or a minute. We need to have buyers come in. Otherwise, it's just, I would consider this a double top too. You trade it up a few ticks and you're back down in the middle of the range, or inside the 30-minute range. There's not really a right or wrong as far as what the market should do. It's just a matter of, okay, were there interested parties to buy, or were the short-term traders able to push the market down because there wasn't enough institutional buying or bigger orders? When you hear institutional buying, it just means big orders. A local in the pits, a short-term trader, they're not putting the amount of size on that a institution's putting on. So if the locals can fade the market at highs and lows, that just means there's not big orders coming in. If you got 1,000 contract order, they're going to come in at 50 contracts, 50 contracts, 50 contracts, and every little pullback, it's going to reverse and go back up. If you don't have those institutional buyers, then there's not that continued pullback, new high, pullback, new high. And we are coming into the end of the month, which tends to be kind of portfolio rebalancing time, the end of the year, end of the quarter. So Um, Lots of reasons for it to be acting like this. Yeah, our breadth and advanced decline line are getting stronger. Did put in a little higher low here, so that's a good sign. But it's still slow. This is what I would kind of look for, a move up to like 78 and then a pullback, call it 39.75 as a long. But it hasn't happened yet. We would have a long way to go even to make it to the halfway back of yesterday. That's up at a 39.89. So 39.75 and a what does it say? 74.75. So basically the top of the 30-minute range would be the long entry. It's not the greatest just because it's still pretty slow as we creep up towards highs. But that's really the only opportunity here. So let's see what we get. I like the nicey ticks to come down. So 74.75. I'll take a stab at that. I need these nicey ticks to come down to the zero line or closer to it. I'm also looking for, okay, as we start to creep up higher, are there, do we start moving higher quicker? Like, are there people starting to chase? Now we're all the way up at 39.75 and a quarter. And you're getting a little bit of that here. I'll really watch these nicey ticks if we start to come down. In some cases, I will delete an order if we're not long in a low tick or short in a high tick. Yeah, now we're all the way up at 39.75. So, 75.75, I mean. Yeah, it's there's just not that many. There's not that much volume, so there's not that many selling orders, and so the few buy orders are able to push things up quite a bit. Now here we're in a high tick, so yeah, no long there yet, anyways. You could come down and make a double bottom here, 75, and then still set up in a long, but I don't want to put a limit order there with a high tick up there. And there's no swing low here to really take a short either. So where that 1 minute chart could come in handy. If you wanted to short going below 39.78 as the short order. Trying to ride it down to a 75. Pretty slow still. I would trade the 1 minute similar to the um, retracement. You use a 3 point target, and then um, the easiest way is to just trail each candle once you kind of get away from the entry price. So like if this candle closes, once this candle closes, you put your stop above its high. You don't want to get too tight in trailing. I mean, it would have worked here, like trailing this next. I guess this was the bar that broke down. But you start to get in here, you get a couple smaller candles. This one's inside, so it really doesn't matter. But um, yeah, I would put my stop above this candle once it closes if you short below the low of the candle. So yeah, there's that move above the candle's high. Not a huge move, but if like let's say over here, you're long above the high to you get in these inside candles, you don't want to tighten your stop below these candles here. Just leave your stop below the initial breakout candle, and then you can catch a bigger move. On these, on the yeah, the like a 1 minute trade, I would just put my stop above, one tick above the candle. So you're basically trading it like the 15-minute breakout. You've got your entry below the candle and your stop above the candle, and then pretty quickly, since it's a 1 minute bar, you get to tighten it. Kind of the opposing short now again. So I mean, when it's slow like this, even some of the trusted setups are hard to come by. Slow, slow, slow. More than likely we would come down and retest this 39.75. So since the short traded first, that's why I don't have the long drawn up. I don't want to necessarily take this as a long because we still have the high ticket highs and we have the short trading already. This little long here didn't break the swing high, so that's a no-go. And you don't want to take a long right here because the short already traded, so we're likely to come down and retest here. What ends up happening, sometimes you get a double bottom where you get a low, you bounce, you get a second low. You come up, you break the 61.8, so you can draw your retracement like this and take your pullback at those prior highs. That's a really nice setup. But again, it's pretty slow today, so we'll see if that happens or not. We're kind of running out of time, which is okay. The market isn't going to give you, no matter what trading strategy you're using, you're not going to get a setup every day. Or not every day is going to be filled with great setups. I don't pay too much attention to the prices on the like order blocks on the dome. A lot of times these computer, the high frequency trading firms throw orders out there and then they remove them like faster than a blink of an eye. Yeah, just crazy fast. And so it can they're not always real orders that are waiting on the bid ask. So it's same with time and sales is more real because it's orders that have been filled. But even that, you break up orders into all kinds of different blocks and mask orders, and come from different locations and stuff. So I don't even pay attention to that. Yeah, I show a high tick at 8:30 and then at 8:30. So we do have our high tick lining up with high price. That's why I flipped to that 1 minute chart um, here, showing this 1 minute candle was the same time as the nicey high tick. So um, that's what kind of triggered that short in that conversation. I never really looked too much at Bookmap, Paul. Market profile, I spend a lot of time with, which I do find valuable. I just, even when I religiously looked at it and did it every day, I wasn't really using it for trade execution. So it was beneficial, but not necessarily needed. Could make a case for a bull flag here. 2 bar sideways, break out, pull back on the 512 to that, double bottom, break the 61.8 scenario like I just commented on. Still plenty of room before the top of the 30-minute range. Sorry, top of the still plenty of room before the halfway back just from yesterday. It's not really, doesn't mean much other than in the context of the next day, like today is. Like when I'm looking at an intraday chart, that's the only time I would really draw up one of those situations where it's the halfway back from the prior day. But we still, even with breaking the 61.8, if we do, still have that high tick of day. I would be, if we broke the 61.8 in the next minute or two, didn't break highs, and then pulled back to the 50%, I'd be 50-50 on taking it. It's pretty late in the morning and it's been pretty slow, but if we go another 10 minutes and it really doesn't do anything, we just shut down. But see how I draw, in order for it, we break the 61.8 and we come up in double top, we're still just barely at these highs. So let's say we break the 61.8 and trade to 80. It would look something like that. So at least the first target, if you did bounce off the 50 long, you could get a first target before we retested highs. So that part's good. But we'll see. Is so far we haven't yet. So still haven't broke that 628. We need a, we'll call it round up. That gives us 79.25. Add 2 ticks, so a 79.75 to print before I consider that broken. And now we've got 2, maybe 3 tests of this 50 short. So more than likely, I mean, we come down, retest the long again, and get the third try to break out. But running out of time here. Yep, have a good one, Mike. Thanks for tuning in. The spread on the 512 tick, or like the highs and lows, um, yeah, they're not as extreme. Like you're not seeing a plus 1,000, minus 1,000, because there's not as much movement in the market itself, in the New York Stock Exchange. You're not having these bigger swings of stocks swinging to extremes. So yeah, in order to take that long, it would have had to be the perfect break, not make it all the way to the double top. I'd be okay taking it if it didn't make it quite to, even if we didn't break highs. But now we're more in a situation where we're dropping back in. Well, let's draw the full halfway back of the day just because. Down in a lowish tick. And even here, by the time you draw up the short, you are almost at the full halfway back of the day. If you came in and used the higher low here, you're basically there. So yeah, I'm gonna end up being a no trade day for me, which is totally fine. I'd rather be flat on the day than down. I think the best way to determine the trend on the day is to draw up the full retracement, the high and low for the day. Um, if you break a retracement in one direction and then you break it in the other direction, then there's no trend. You've broken the short, broken the long. Also, looking at the high and low for the 30-minute range, today we are within the 30-minute range. We're back in. And okay, where did we open? Well, pretty close to where we started, or we're pretty close to where we're trading. So we are not in the trend. I mean, we had a little 30-minute uptrend here, but it was pretty choppy on the way up. Look at these, tails, and then this whole cluster was really sideways. You had the one breakout bar, and then immediately inverted hammer, and then back down. So, yeah, no major trend here. Yeah, the breadth number on the left, that 4.2 is a volume ratio. How much volume is going to up versus down stocks, and the AD line is the net number of stocks moving up versus down on their last print. Sometimes, a second goes by and there's no change, or there's no recorded change in the price, so it's just unchanged. But I think I'll leave it at that for today. Even here, the swing high, I wouldn't consider this the swing high. That is all the way up here. So there's not even a swing high to break, relatively close. I mean, if you drew up this as a tiny long here, that'd be pretty small. Not really worth risking in my book if it didn't even move up above the one candle high yet. But, that's what I mean when you talk about getting real granular and super tiny like that. It's just not worth it. For the 15-minute breakout, I am using the absolute high and low of the candle. So like this morning, even though it was a no trade, I'd be using the low of the candle. So 39.63 is the low. I'd be putting a sell stop one tick below that, so 62.75. And at the same time, I put a buy stop at 39.75, one tick above highs. And then whichever one trades, the other one becomes my stop. So if I had taken it today, the short would have gotten me short, and then the long on the other end would have been the stop. Determining that it was a no trade today was based off of the close of the last 15-minute candle, so the settlement candle. So this final candle, this green candle here, it started, so its 15-minute block started at the bell, the NYSE close, the official NYSE close, and went another 15 minutes, and that's the settlement candle. So those are the numbers that are reported as the settlement. So that is the close that I'm using as the gap fill. So versus this is the close of the day, the NYSE close, but this up here is the actual settlement close. So that's the number I'm using as my gap fill, as my close of the day. So if you're on like the SPY chart, these numbers are the 4 p.m. Eastern close. Whereas with futures, you've got that settlement candle, and that's the candle, and that's what I use for all the gaps, and that's what's, those are more the official numbers when the S&P and Dow are reported as far as futures go. So yeah, we'll leave it at that. This short here, if we weren't trading at the halfway back long, I would like it, but because the long already traded, now we're right back into this, choppy potential, just rip through scenario. So leave it at that for today. It's okay to not have a trade. It's okay to sit on your hands because then when you have a good day come up, let's say tomorrow we get a 15-minute breakout and a couple of retracements, all of a sudden you go from being flat on Tuesday to up versus if you got stopped out a bunch today and you're kind of frustrated and kicking yourself, now on Wednesday you kind of have to dig yourself out of that hole and mentally you can be a little hung up too. So thanks for tuning in, everyone. We'll do it again next Tuesday, and then Monday night will be the master class. So it'd be next Monday, the 5th, at 6 p.m. Eastern. So hope everyone has a good rest of your day, and I'll talk to you everyone soon. Thanks so much.